The second quarter earnings season is in full swing now, reflecting the current health of corporations. Research Director Shiraz Mian says it was a good start, and as we speak, this is the busiest week here. And Shiraz is here with me now to fill us in on all the action so far. So, Shiraz, what made it a good start?
So, you would recall, Terry, and our listeners, the regular folks who regularly consume our commentary know that ahead of the start of this earnings season, there was a very favorable revisions trend for Q2, meaning estimates did not really fall as much as they historically have done. And the downside, if you will, of that was was it too high and difficult a hurdle for these companies to overcome? And that wasn't the case at the start, and also now while we are in the thick of it. So it was a good start, and that continued through the through the earnings season.
The big banks kicked off the reporting cycle as they always do. And back then, you wrote that they're still facing multiple headwinds pressuring their profitability. What are they?
So the Fed, which for all market participants is the big variable, really raised rates extraordinarily last few years. And what happened as a result was that short-term interest rates went above long-term interest rates, what we call as the inverted yield curve. And in such an upside-down interest rate environment, it becomes very difficult for banks to make money. Banks get their money from depositors who can come back for their money anytime, and then they lend it out on fixed duration to consumers and homeowners and businesses. And when long-term interest rates are lower than short-term interest rates, then it's hard for them to make money. And on top of that, the economy's been kind of moderating. There's been pressure, financial pressure at the bottom end of the income distribution. So a bunch of different things that come in the way of banks operating normally, and they have, in my judgment, and the numbers show that done a reasonably good job of operating in this environment.
Yeah, that inverted yield curve especially has been problematic for a while now. So let's recap the financial sector in light of those big bank earnings.
Sure. So almost 80% of the Zacks finance sector market capitalization has already reported Q2 results. Total earnings for these companies are up almost 10%, 9.9% to be precise. Revenues are up 6.6%. Almost 90% of these finance companies beat EPS estimates, and 66.2% beat revenue estimates, and that's a better performance than we have seen from these finance companies in recent quarters. And given all the headwinds that we discussed earlier, that's a pretty impressive performance.
Now let's widen out to the big picture overall: growth, margins, beats, etc.
Sure. So when you step back from finance and look at the market as a whole, the index as a whole, 343 S&P 500 companies have reported results. I'm giving you the real-time number, meaning it includes this morning's results. That's 68.6% of the index's total membership. So 2/3 of the results are in. Earnings for these companies, Terry, are up 11.7%. Revenues for these companies are up 5.1%. 80.2% are beating EPS estimates, and 53.1% are beating revenue estimates. All of this is better numbers than we have seen from these companies in recent quarters. If there's one area that one can put a finger on and point to as weaker or relatively weaker compared to recent quarters, that would be revenue beats. Revenue beats are towards the lower end of the range for recent quarters. So companies have been struggling to beat revenue estimates. EPS beats are great, margins are reasonably good, and the growth rate appears to be not only better than expected, but in fact showing some acceleration.
And here on August the 1st, we've been hearing from the big tech companies. Now, as far as you can tell, do their earnings reflect that the big techs have lost their momentum?
So I'm not of that opinion, Terry. The market seems to be a little concerned and disappointed with the results that have come out. Microsoft has reported, Alphabet, the Google parent, has reported, Tesla has reported. We have the Meta results last night. That's the Facebook parent, and we have Amazon and Apple on deck to report. So the way I see it, the things that investors and the market participants find problematic, in my judgment, is a net positive. And let me explain what I mean by that. The market has been concerned with this ever-rising capital expenditures from these big tech companies, the Microsofts, the Alphabets, and also Meta, on artificial intelligence infrastructure. The growth from these companies is as impressive as it has been in recent quarters. In fact, one of the most amazing things to see is for these trillion-dollar companies to have these impressive results. Just to give you one example, the market didn't like the Microsoft results because its cloud revenues were up only 30% when they expected a 31% growth. So growth is good, and they are investing for future growth, which I think is a net positive for the long run. But market participants feel that this ever-rising trend of CapEx, when it's not clear artificial intelligence has a clear business case, that's basically the source of worry for investors.
But it seems like this time around, companies missing expectations are being punished less than usual in the market. And that seems like kind of a major theme this time. Is that a good sign?
So I would call it a good sign if it wasn't accompanied with relatively favorable commentary about the future. So when a company misses estimates and is tentative about the future, then they deserve to be punished. But if a company misses estimates and has good things to say about the current period and the coming periods, then that does provide some reason for investors for optimism for the coming periods, and that I think is justified because the stock market, as we all know, is a forward-looking system, and if results for the quarter that's in the rear-view mirror were not as strong, but the company is promising better days ahead, then that's reason for optimism, and in that context, it's a positive.
So what's the estimated growth rate for Q2 at this point?
It'll be the best since 2022, the beginning, the first quarter. It's on track to be almost 10%. In fact, if we combine the results that have come out with estimates for the still to come companies, growth is expected to be 9.8% and 5.3% revenue growth, and the rest of the earnings growth coming from expanding margins.
And when you look at growth expectations for Q2 and for later this year, maybe even next year, Are companies going to have a higher bar to clear as far as meeting and exceeding expectations?
I believe so. That's a very good observation, Terry. That's what I was explaining in the context of Q2 as well. That since estimates had not come down as had historically been the case, it was one of those cases of a higher bar to cross. And yes, that will be the case for the second half of the year as well, because we are not seeing estimates coming down as much as has historically been the case.
And how significant is that higher bar in relation to stock valuations?
So it gives you more confidence about corporate profitability. So if estimates are not coming down, if management teams are standing behind what investors are expecting for the future quarters, if you combine that with an interest rate backdrop, with the Fed expected to start cutting rates at some stage in the near future, then all of that is very positive for stock prices, and is a very solid fundamental reason to be optimistic and to be invested.
All right. Want to remind all of our listeners that they can keep track of your written commentary on Zacks.com. You can access it right off the homepage. It changes every Monday and Thursday. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.